Today we're tackling, well, probably the most powerful three-digit number in your financial life.
Absolutely. The FICO score.
Exactly. It affects almost everything, right? Getting an apartment, that car loan, definitely a mortgage,
Yeah.
and how much you end up paying for it all.
It really is the gatekeeper.
Yeah.
Our goal today really is to get under the hood, understand the mechanics, who the players are, and just how massive its influence actually is, all based on the sources you send over.
Okay, let's start at the beginning. FICO. And it used to be Fair Isaac Corporation, didn't it?
Yeah, they officially shortened it back in 2009, but they've been around a long time.
Since when?
Founded way back in 1956, engineer Bill Fair and mathematician Earl Isaac. Their whole idea, pretty revolutionary then, was an algorithm.
An algorithm to predict what exactly?
Consumer credit risk. At its heart, a FICO score answers. How likely is this person to pay us back?
Simple question, huge implications.
Precisely. So if a lender sees a score of, say, 600, that's usually considered subprime. The score is basically a mathematical prediction. Based purely on past behavior, it suggests a higher chance you might struggle with repayment.
And the reach of this thing is staggering.
Oh, absolutely. 95% of the big U.S. financial institutions use FICO.
95%.
It's the plumbing of American debt, really. They've sold over 100 billion scores since they started. And think about housing. 3/4 of all mortgages rely on FICO data. It's a massive economic force.
Okay, so FICO builds the engine, the algorithm, but an engine needs fuel. Where does the actual data come from? Who else is involved here?
Right. That leads us to the credit reporting agencies. You probably know them as the credit bureaus.
Okay.
Think of them as giant data collectors. They gather up, sort through, and package individual credit info. Then they sell that report, including the FICO score calculated from that data, to lenders.
And in the U.S., it's basically dominated by just three companies, right?
The big three, yeah. Experian, Equifax, and TransUnion. Now, here's a key point for listeners. The bureaus themselves don't decide if you get credit.
Ah, that's important.
Very. They're just the messengers, the data providers. They hand the risk assessment, the report and score to the bank or the mortgage company or the credit card issuer. They make the final call.
So where are Experian, Equifax, and TransUnion getting all this personal financial dirt on us?
Well, it comes from various places. The creditors themselves report your activity, debt collectors provide information, and also public records, things like bankruptcy filings or court judgments. Basically, every time you use credit or pay a loan installment, that gets reported. It creates a record for that account.
A trade line, you called it earlier.
Exactly. A trade line. That's the jargon for the history of a specific account.
Got it. Now, dealing with these bureaus can feel tricky. But we do have rights as consumers.
Definitely. Thanks mainly to the FCRA, the Fair Credit Reporting Act from 1970, and a big update in 2003.
Which was called?
FACTA, the Fair and Accurate Credit Transactions Act. That's the law guaranteeing you one free credit report every year.
From each of the big three?
Correct. One from Experian, one from Equifax, one from TransUnion, every 12 months. It's crucial for checking that the data they have on you is actually accurate.
Okay, this is where I think it gets really fascinating. The formula itself, the secret sauce.
Yeah.
FICO scores run from 300 to 850. What's considered good?
The sources generally put good in the 670 to 739 range. Solidly good.
And it boils down to 5 main things with different weights.
Yep, 5 categories. And the weightings are really telling. The absolute biggest chunk, a massive 35%, is payment history.
35%. Just on whether you paid on time.
Pretty much. It covers everything, bankruptcies, stuff sent to collections, even being just 30 days late on one payment. It all feeds into that 35%.
So rule number 1, above all else, pay your bills on time. What's next?
The second biggest factor at 30% is accounts owed or, indebtedness.
30%, okay.
But this is where people often get tripped up. It's not just how much you owe in total dollars. It's about the credit utilization ratio.
Explain that. Utilization ratio.
It's the amount you owe compared to your total available credit. How much of your credit limit are you actually using?
Okay, let's use an example. If I owe, say, $100,000, but my total credit limits across all cards and loans add up to $1 million.
Your utilization is only 10%, which looks pretty good.
But if I owe just $10,000, but my total limit is also only $10,000.
Then your utilization is 100% maxed out. And even though you owe much less money overall, that 100% utilization looks way riskier to FICO than the person owing $100 with 10% utilization.
Wow. So owing more can actually be better for your score as long as it's a small percentage of your available credit.
Precisely. The golden rule here is stay well below your limits. Ideally, keep your utilization below 30% across all your revolving accounts, like credit cards.
Why is high utilization seen as so bad?
Because if you're using, say, 90 or 100% of your available credit, it suggests you're really reliant on borrowing to get by. FICO interprets that as a sign you might be under financial stress, maybe close to defaulting. It's a powerful predictor.
Okay, 35% payments, 30% utilization, that's 65% right there. What's the third piece?
Third is length of credit history. That accounts for 15% of the score.
15%.
But what goes into that? It looks at a few things. How old your oldest account is, how new your newest account is, and the average age of all your accounts combined. Generally, the longer your history, the better.
What does that mean for someone younger, just starting out? They can't magically make their accounts older.
They can't, which means they need to be extra careful about those top two factors, payments and utilization. Max those out. And be strategic about history. Don't just close your oldest credit card, even if you don't use it much. Keeping it open helps maintain the average age of your accounts. That 15% builds slowly over time.
Good practical tip. Okay, that leaves 20%. What makes up the rest?
It's split into two 10% chunks. First, credit mix. That's 10%.
Credit mix. Variety, you mean?
Exactly. FICO likes to see that you can handle different kinds of credit responsibly, like maybe some credit cards, that's a revolving credit, plus an installment loan, like a car loan or a mortgage. Having a mix is generally better than just having one type.
And the final 10%.
That's new credit, also 10%.
This is about applying for too much credit too quickly.
You got it. Opening a bunch of new accounts in a short period can look like you're desperate for funds, which flags you as higher risk. Also, every time you formally apply for credit, it usually results in a hard inquiry on your report.
And hard inquiries can ding your score a little.
They can temporarily. Too many hard inquiries in a short time frame contributes negatively to this 10% factor.
Okay, so recapping the big levers. Pay absolutely everything on time. Keep card balances low compared to their limits, definitely under 30% utilization. Let your accounts age. Have a mix of credit types. And don't go on a spree applying for new credit all at once.
That's the core of it. But
Yeah.
there's a complication.
What's that?
There isn't just one FICO score.
Ah, right. You hear people talk about my FICO score like it's a single number.
Yeah, but that's not quite right. FICO has released loads of versions since 1989, and right now there are actually 19 different FICO score versions commonly in use.
19. Why so many?
Well, they tailor them sometimes for specific industries, like auto lending or credit cards, and they release newer versions with updated modeling. Plus, remember the big three credit bureaus?
Experian, Equifax, TransUnion.
Right. A lender might use a FICO score calculated using data from just one of those bureaus. So you could have a FICO score based on Experian data, another based on Equifax, and a third on TransUnion. And they won't necessarily be identical.
Okay, that's confusing. Is there one version that's used most often?
For general consumer lending, like credit cards and auto loans, FICO Score 8 is still the most widely used, even though FICO 9 and FICO 10 are out there.
What was special about FICO 8 when it came out?
It tweaked a few things. It became more sensitive to high credit card utilization, penalizing it more heavily. But it was also a bit more forgiving of isolated late payments, like if you had one slip up, but were otherwise perfect.
And didn't it introduce something helpful about small collection accounts?
It did, the low balance exclusion. FICO Score 8 ignores collection accounts if the original amount owed was less than $100. That was a nice little break for consumers.
Okay, so FICO 8 is common, but you mentioned mortgages earlier,
Yeah.
and something about older scores.
Yes, this is really critical. When you apply for a mortgage, lenders very often don't use FICO 8 or 9. They typically pull older versions.
Older versions, like which ones?
Often FICO Score 2, FICO Score 4, or FICO Score 5. These are much older models.
Why on earth would they use old versions for something as huge as a mortgage?
It mostly comes down to regulation and consistency. The mortgage industry, especially after the 2008 crisis, relies on models approved by government-sponsored enterprises like Fannie Mae and Freddie Mac. They've been slow to approve the newer FICO versions, sticking with the ones that have a very long track record, even if those older scores are less sophisticated or less forgiving in some ways.
So wait, I could be managing my credit perfectly, according to FICO 8 rules, maybe ignoring a tiny $80 medical collection because FICO 8 ignores it,
Exactly.
only to apply for a mortgage and find out the lender is using FICO Score 2, which does count that $80 collection against me.
That is precisely the kind of situation that happens. You optimize for the common score, but the specific lender, especially for a mortgage, uses a different, older rulebook. It catches a lot of people by surprise.
Man, that complexity must be part of why competitors popped up, like Vantage Score.
I think it definitely played a role. VantageScore came about in 2006. It was actually created by the big three bureaus, Experian, Equifax, and TransUnion, working together.
Interesting. Does it use the same 300/850 scale?
Yes, same scale, but it works differently underneath.
How so? What's the big difference?
Remember how we said FICO scores are often based on data from just one bureau, so you can have 3 different FICO scores?
Right.
VantageScore tries to solve that. It's designed to pull data from all 3 bureaus simultaneously and create a single, more consistent score based on that combined information.
That's better. More logical.
Potentially more consistent day to day, yes. Another big difference is how easy it is to get a score in the first place.
What do you
Well, to generate a traditional FICO score, you usually need at least one account, one trade line that's been open for 6 months or more and has had activity within the last 6 months.
Okay. What about Vantage Score?
VantageScore is less strict. It generally only requires one trade line, period. Doesn't matter how old it is.
Ah, so someone new to credit, like a young person or an immigrant, could potentially get a Vantage Score much sooner than a FICO score.
Exactly. That makes it easier for people with thin credit files to get on the scoring ladder.
So we've got FICO with its many versions, Vantage Score is a major competitor. It feels like the whole credit scoring world is still shifting.
It definitely is. And the sources suggest lenders know this. Consumer behavior is changing. Younger generations may be using credit cards differently, being more debt averse.
Right.
So there's talk that lenders might start looking beyond just these scores. They might incorporate other financial data points in the future.
Like what kind of data?
Things like your history paying rent on time or utility bills, maybe even subscription payments. Data points that aren't part of the traditional credit reporting system
Right.
to get a fuller picture, especially for those with limited credit history. So if we boil down this whole deep dive, the FICO score, it's hugely influential, dominant really, used in like 90% of lending decisions.
Yeah, it's the big one.
And improving it comes down to, well, 2 main things fundamentally. Using credit responsibly, especially keeping that utilization low, under 30%. And second, just relentless consistency with on-time payments, every single time.
Solid advice. But it's also crucial to remember, right, that the score isn't the only thing lenders look at.
Absolutely not. They still consider your whole financial situation, your income, how stable your job is, your overall debt load compared to your DTI ratio, and of course, what kind of loan you're actually asking for.
Okay, so here's a final thought to leave everyone with based on everything we discussed. We know FICO uses data from just one bureau for a given score. And we know mortgage lenders often use those older FICO versions like 2, 4, or 5.
Yeah, that's the tricky part.
So the question for you, the listener, is, if you're planning to apply for a major loan, especially a mortgage, what specific steps can you realistically take to figure out which specific FICO score version that particular lender is actually going to use to judge you? Because knowing the test beforehand, well, that changes how you study.
That's the challenge, something to dig into before you apply.
Definitely something to explore. We'll leave it there for this deep dive. Catch you next time.